In this lecture, I'll be looking at IFRS 5, non-current assets, held for sale and discontinued operations. So I will examine the following. Number one, classification. Classification of assets held for sales in accordance with IFRS 5. Measurement of non-current asset held for sales. Presentation of non-current assets held for sales in accordance with IFRS 5. That is, how assets held for sales will be presented in the financial statements. Then conditions. Conditions for an entity to recognize an asset as held for sales. I will also solve work examples. If you are just joining us for the first time in this YouTube channel, or if you have not subscribed in the past, please don't forget to click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. IFRS 5 set out the requirements for classification, measurement, and presentation of non-current assets held for sales. IFRS 5 set out the requirements for the classification, measurement, and presentation of non-current assets held for sale. A non-current asset is classified as held for sales if its carrying amount will be recovered principally through a sale transactions rather than through a continuing use. A non-current assets will be classified as held for sale if its carrying amount, that is, if its net book value will be recovered principally through a sale transaction rather than through continuing use. That is IFRS 5. A non-current asset will be classified as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. IFRS 5 gives the condition for classifying an asset as held for sales. Condition for an asset to be classified as held for sales. Conditions for an asset to be classified as held for sale. The asset Number one, the asset. The asset must be available for immediate sale. For immediate sale in its present condition. An asset will be classified as held for sales in accordance with the requirement in IFRS 5 if that asset is available for immediate sale in its present condition. Number two, the sale is expected to be completed within 1 year. 1 year from the date of its classification. In accordance with IFRS 5, an asset will be classified as held for sale if the sale must be completed within 1 year from the date when this asset is classified as held for sale. Number three, it is unlikely that there will be any significant changes to the plan, or that the plan will be withdrawn. That is, there will be there is unlikely, that is, there will be no significant changes to the plan to sell the asset. There will be no changes to the plan to sell the asset. That is, it is unlikely that there will be any significant changes to the plan, or that the plan will be withdrawn. The plan to sell the asset will not change. The entity must be committed to sell the asset. Number four, the sales must be highly probable. Number four, the sale must be highly probable. The sale must be highly probable. What do you mean by that? It means the management are committed to plan to sell the asset. That is, management are committed to plan to sell the asset. That is, the sale is highly probable, means that management are committed to sell the asset. Number two, there is an active program to locate the buyer. There is an active program to locate the buyer. Number three, the sale is being actively marketed the sale is being actively marketed at a price that is reasonable. That is the meaning of the sale must be highly probable. These are the conditions for an asset to be classified as held for sales in accordance with IFRS number 5. I therefore want to examine the measurement of an asset as held for sales in accordance with IFRS 5. Measurement of non-current asset held for sales. Measurement of non-current assets held for sale. Non-current asset held for sale should be measured at the lower of the carrying amount or fair value less cost to sell. Non-current asset held for sale should be measured at the lower of 1. Carrying amount, 2. Fair value less cost to sell. It should be measured at the lower of carrying amount, that is the label value, or fair value less cost to sell. Then we have presentation of non-current assets held for sale. Presentation of non-current assets held for sales. Non-current asset held for sale should be presented separately on the face of statement of financial position under current assets. Non-current assets held for sales should be presented separately on the face of statement of financial position under current assets. It should be presented as current assets. Should be presented separately as current assets, and it should not be depreciated. It should not be depreciated. That is presentation of non-current assets held for sale. Example: on 1st January 2021, Michelle bought a chicken processing machine for $20,000. It has an expected useful life of 10 years and a nil residual value. On 30th of September 2023, Michelle decides to sell the machine and starts actions to locate a buyer. The machines are in short supply, so Michelle is confident that the machine will be sold fairly quickly. Its market value at 30th of September 2023 is $13,500, and it will cost 500 naira to dismantle the machine and make it available to the purchaser. The machine has not been sold at the year end. At what value should the machine be stated in Michelle-Co's statement of financial position at 31st December 2023. This question is obtained from ACCA Studies Test by Kaplan. Now, let's have the solution. I've talked about measurement of non-current asset held for sales. I've told you that it should be measured at the lower of the carrying amount and fair value less cost to sell. The lower of the carrying amount, that is the label value, and the fair value less cost to sell. Now, let's have the solution. Solution. Michelle-Co. Now you have to measure the carrying amount of Michelle-Co non-current assets. As at the date this non-current asset is to be classified as held for sale. You know, on 30th of September 2023, Michelle-Co decided to sell the machine. As of September 30, they decided to sell the machine and start actions to locate the buyer. This is the date. I think the September 30, 2023 is the date the actions to locate the buyer begun. So, as at this date, this asset should be reclassified from non-current asset to non-current asset held for sale in accordance with the requirement in IFRS 5. Now, what will be the carrying amount of this machine as at 30th of September 2023? Remember, this asset had been acquired as at 1st of January 2021. That means the asset will have been depreciated as at 2021 financial year. From January to December, 12 months depreciation will have been charged in 2021. In 2022, 12 months depreciation will also be charged, meaning that 2 years depreciation will have been charged. Then as at 2023, this asset will still be recognized as non-current asset up to this September 30, 2023. The day this asset is to be classified as held for sales. That means the depreciation for January 2023 to September 2023 will still be charged. That means we're having depreciation for 2021, depreciation for 2022, and 9 month depreciation in 2023 before this asset will be classified as held for sales. So now let's determine the carrying amount of Michelle-Co machine as of September 30, 2023. So let's have the carrying amount as at September 30, 2023. So we want to determine the carrying amount of the machine. Carrying amount of the machine. So you have the cost as at 2021. The asset cost $20,000. As at 2021, it cost $20,000, and it has a useful life of 10 years and a nil residual value. That means during 2021, depreciation will have been charged. Depreciation for 2021 will be 20,000 divided by 10. That means 2,000 depreciation will be charged in 2021. Then when you get to 2022 also, you will also charge depreciation. Since straight line method of depreciation is to be used, that means 2,000 will also be charged as depreciation. Then you now get to 2023. Remember, this asset is to be classified as held for sales as at September 30. We will still charge depreciation 20,000 divided by 10 times depreciation for January to September, which is 9 months, will still be charged. We have 2,000, no depreciation, 20,000 divided by 10, that is 2,000 times 9 divided by 12. That is 1,500. That is the amount of depreciation that will be charged in 2023. So the carrying amount as at December 2023 now, we have, if you the total depreciation that is to be charged to date, 2,000 plus 2,000, that is 4,000 plus 1,500, that is 5,500. If you subtract 5,500 from the cost of 20,000, you'll be having the carrying amount to be 14,500. The carrying amount of the machine is 14,500. If the carrying amount is 14,500, and I've told you that the asset should be measured at the lower of carrying amount, we have ascertained or we have determined the carrying amount of the machine as at September 30, 2023. Therefore, what is the fair value less cost to sell? Now, fair value measurement is covered in IFRS 13. Now, its market value as September 30 September 2023 is 13,500. This is the market value. Market value as at September. This is fair value. And it will cost 500 to dismantle the machine. So the cost to sell is 500. Therefore, fair value less cost to sell will be 13,500 minus 500. Therefore, we have fair value less cost to sell. Less cost to sell, 13,500 minus 500. So you'll be having 13,000. So now that we have 13,000, the 13,000 is lower than 14,500. Therefore, this asset should be reclassified. You are going to recognize it as current asset in the statement of financial position. The machine qualifies. Now, the machine qualifies as held for sale. The machine qualifies as held for sale on 30 September 2023. It qualifies as held for sale on 30th of September 2023. So the machine should be stated at the lower of the carrying amount of $14,500 and net realizable value, that is net realizable value of 13,000. That is the fair value less cost to sell. If you look at the carrying amount of 14,500, which had earlier been recorded in the financial statement, it is lower than the 13,000 which you want to restate the value to be. That means the difference represents the impairment loss. Impairment loss of 1,500. Impairment loss of $1,500. That is the difference between 14,500 and 13,000. Impairment loss of 1,500 should be charged in the statement of profit or loss. Remember, you are going to record 13,000 as current asset. The 13,000 should now be recorded as current asset. That is non-current asset held for sale. In the statement of financial position. Finally, the machine will no longer be depreciated. The machine will no longer be depreciated. That is the solution to the question. So, I want to examine discontinued operation. Discontinued operations. Discontinued operation is the component of an entity that has either been disposed of or classified as held for sales. The component of an entity that has either been disposed of or classified as held for sales. In accordance with IFRS 5, discontinued operations should be shown separately in order to help users to predict future performance. Discontinued operations should be shown separately in accordance with IFRS 5 in order to assist the users to predict future performance. The analysis of single amount, that is profit or loss from discontinued operation, must be presented either in the notes or on the face of the statement of profit or loss. Now, I therefore want to examine the format for preparing the income statement where there is discontinued operations. Now, suppose the name of the entity is XYZ Limited. You have statement of profit or loss for the year ended December 31st, 22x. So, you have to show the profit from continued operation. So you start with revenue, just like the normal statement of profit or loss in IAS 1. Then cost of sales. After deducting cost of sales, you arrive at gross profit. Gross profit. Then we have distribution costs. We have administrative expenses. After deducting that, we have profit from operations. Then you have other income and finance cost. Other income, finance cost, you have profit from continued operation before tax. Profit before tax. profit before tax from continuing operation. Then we have income tax expense. We have profit for the period from continuing operations. Then income tax expense. Then this is the profit for the period from continuing operation. Then we now have profit or loss from discontinued operations. If it is profit, you add it, and if it is loss, you subtract. Now have total profit for the period. The analysis of the profit or loss from discontinued operation may either be shown by the way of note or on the face of the statement of profit or loss. So this is the format for preparing the statement of profit or loss where there is discontinued operations. Example: Whiskey Bottling Company PLC specializes in the production of alcoholic wine known as Blue Bull and soft drink called Whiz Cola. Hence, the company operates two divisions, that is Blue Bull and Whiz Cola division. Due to high cost of labor and shortage of raw materials for the production of the wine, the Blue Bull division has incurred significant operating losses. Management decided to close down the Blue Bull division and draw up a plan to discontinue operations of the division. On February 1st, 2019, the board of directors of Whiskey Bottling Company PLC approved and immediately announced the formal plan. The following figures are available for the current and prior year ending March 31st. We have 2019 and 2018. Blue Bull, Whiz Cola, that is for 2019. Then 2018 we have Blue Bull and Whiz Cola as well. We have revenue, cost of sales, administrative expenses, distribution costs. Other operating expenditure, taxation expenses stroke credit, additional information. The following additional costs are directly related to the decision to discontinue operation and are yet to be accounted for. Severance payoff 42.5 million naira was incurred between February 1st, 2019 and March 31st, 2019. A proper evaluation of the recoverability of the assets in the Blue Bull division in terms of IAS 36 led to the recognition of an impairment loss of 9.5 million naira, which is included in other operating expenses above. Required: 1. Draft the statement of profit or loss for Wizkid Bottling Company PLC for the year ended March 31st, 2019, together with the comparative figures for year 2018. 2. The directors of finance of Wizkid Bottling Company PLC stated that there should be some additional disclosure about the discontinued operations, which should be shown in notes to the financial statements of the company. Identify 3 of such disclosure requirements in accordance with IFRS 5. This is ICANN May 2021 financial reporting. This is B, question B. The A part of the question has been explained as part of my presentation on IFRS 5. Now, let's have the solution. Back to the question. The name of the entity is Wizkid Bottling Company PLC. If you look at the requirements, 1, you are to draft the statement of profit or loss for Wizkid Bottling Company PLC for the year ended March 31st, 2019, together with the comparative figures for year 2018. Now, solution. The name of the entity is Wizkid Bottling PLC. You want to prepare statement of profit or loss for the year ended. The year end of the entity is March 31st. For the year ended March 31st, 2019. You have 2019, and then you also have 2018 comparative figure. The comparative figure for 2018. There are triple zeros on the head of those figures, so you should add yours. If it is million, then you should also put million, and if you have billion, you should also put billion. Now, you start with continuing operation. Operations. The first item is revenue. 20, you want to discontinue Blue Bull. You want to discontinue Blue Bull. You have been told in the question. You want to discontinue Blue Bull. That means the only continuing operation is Wiz Cola. Wiz Cola. So revenue for 2019 is 1,570,000. And that of Wiz Cola 2018, 1,250,000. Revenue 1,570,000 and 1,250,000. After revenue, the next item will be cost of sales. Cost of sales of Wiz Cola 2019 505,000 and 2018 450,000. We have cost of sales 505,000 and 450,000. By the time you deduct cost of sales from revenue, you arrive at the gross profit. Gross profit 1,570,000 minus 505,000 Then the gross profit of 1,065,000. Then 1,250,000 minus 450,000. You'll be left with 800,000 as gross profit. After gross profit, the next item is distribution cost. Distribution cost. Distribution cost. 2019, 186,500. 2018, 157,500. 186,500 and 157,500. After distribution costs, we have administrative expenses. Administrative expenses. 2019, 311,000. 2018, 255,000. 311,000 and 255,000. This have been considered. Then we have other operating expenditure, 124,500 and 102,500. Other operating expenses, 124,500 and 102,500. Let's subtract our operating expenses from the gross profit. 1,065,000 minus 186,500 minus 311,000 minus 124,500. Then we have 443,000. Same for 2018. Gross profit of 800,000 minus 157,500 minus 255,000 minus 102,500. Then you have 285,000. That is our profit before tax. Then we now have, if you go back to the question, we have taxation expenses through credit, 130,500 and 85,000. Taxation expenses, we have 130,500 and 102,000, and 85,000. So when you subtract, let me reconfirm this. 800,000 minus 157,500 minus 255,000 minus 102,500, 285,000 minus 85,000. Then you'll be left with 200,000. 200,000. Then 443,000 minus 130,500. You are left with 312,500. That is profit from continuing operation. Then the next item is discontinued operation. Discontinued operation, which may result in either profit or loss. So now we want to calculate the discontinued operation. Workings. We have 2018 and 2019 as well. Amount in thousands naira. The first item is revenue. Revenue 20. No, this is discontinued operations. Revenues for 2019. That is for Blue Bull. We have 235,000. 235,000. That of 2018, we have 250,000. 250,000. After revenue, the next item is cost of sales. Cost of sales. Cost of sales. That of Blue Bull 175,000. 2019 175,000. 2018 we have 200,000. By the time you subtract that, you have gross profit. Gross profit 235,000 minus 175,000. You'll be left with 60,000. Then 250,000 minus 200,000. This is, you are left with 50,000. After gross profit, you have distribution cost. Distribution cost. (2019) distribution cost 20,000 and 10,000 respectively. 20,000 and 10,000. We also have administrative expenses. Admin expenses. Administrative expenses. This is 35,000. And this is 25,000. You have other operating expenses, 15,000 and 10,000 respectively. Additional information. The following additional costs are directly related to the decision to discontinue operation and are yet to be accounted for. Severance pay of 42.5 million naira was incurred between February 1st, 2019 and March 31st, 2019. A proper evaluation of the recoverability of the assets in the Blue Bull division in terms of IAS 36 led to the recognition of an impairment loss of 9.5 million naira, which is included in operating expenses above. We have an impairment loss of 9.5 million. It's included in operating expenses of 15 million. Remove it from other operating expenses. Now let's have other operating expenses. For 2019, we have 15,000 minus 9,500. The 9,500 is the impairment loss. 15,000 minus 9,500. You are left with 5,500. Then impairment loss. Impairment loss of 9,500. You were told that impairment loss have been included in other operating expenses. That is why the impairment loss was removed from other operating expenses. How much is other operating expenses in 2018? Other operating expenses in 2018 amounted to 10,000. So we have 10,000. 10,000. There is no impairment loss in 2018. Now, we also have severance pay. Severance pay of 42.5 million was incurred between February 2019 and March 31st, 2019. So we have severance pay 42.5 million 2019, 42.5 million 2018 need. So let's cast the figures. Gross profit 2019 60,000 minus distribution cost of 20,000 minus 35,000 administrative expenses minus 5,500 minus 9,500 minus severance pay of 42,500. We have 52 loss of 52,500. That is loss, negative. Profit or loss before tax. Then 2018 gross profit of 50,000 minus 10,000 distribution costs minus administrative expenses of 25,000 minus 10,000 impairment 10,000 other operating expenses. Then you have profit of 5,000. 5,000 profit. Now taxation. Expenses stroke credit. Taxation expenses, the credit was put in braces here. That means this is tax credit. 3,000 is tax credit 2019. Tax credit is plus. Why tax expense of 1,500 in 2018? After those adjustments, so 52,500, this is taxation expenses stroke credit. 3,000 is tax credit, 1,500 is tax expenses. 52,500 minus 52,500 plus 3,000. We have 49 minus 49,500. Then 5,000 minus 1,500, that will be 3,500. Let's incorporate the profit or loss from discontinued operation into our income statement. In 2019, we have loss of 49,500, while in 2018, profit of 35. Now, we now have profit or loss from discontinued operation. 2019, loss of 49,500. 2018, profit of 3,500. By the time we add it to our profit from continued operation, so 312,500 minus 49,500. Then we have 263,000. Then 200,000 plus 3,500, you have 203,500. This is total profit for the period. That is requirement 1. Requirement 2. Directors of Finance of Wizkid Bottling Company PLC stated that there should be some additional disclosure about the discontinued operations, which should be shown in notes to the financial statements of the company. Identify 3 of such disclosure requirements in accordance with IFRS 5. Now let's have the solution to that too. Disclosure requirements. This information must be disclosed. Number 1, a description of the division of the company to be disposed. A description of the division of the company to be disposed must be disclosed. 2, a description of the facts and circumstance that led to discontinuance of operations must also be disclosed. Number 3, the revenue, expenses, and pre-tax profit or loss of discontinued operations must be disclosed as well. Number 4, a description of the facts and circumstance leading to the expected manner and timing of the disposal. This must also be disclosed. Number 5. The gain or loss recognized on the measurement to fair value less costs to sell. This must also be disclosed. These are the information that must be disclosed on discontinuous or discontinued operations in accordance with IFRS 5. This is the end of my presentation on IFRS 5. My next presentation will examine the important areas or aspects here to examine. Thanks for watching Ezeka.